Welcome to the deep dive. Today, we're cutting through the complexity of, well, one of the most stable yet intensely niche real estate markets in the Midwest,
That's right.
specifically the Greater Indianapolis senior living apartment sector. And we're focused squarely on the investment opportunities driven by 2025 trends.
Yeah.
We've basically taken this massive stack of demographic forecasts, stabilized cap rate reports, financing blueprints, a lot of dense material. And our mission today is really to transform all that specialized info into crystal clear, actionable insights, about where capital needs to move in Indy, like right now.
And that movement, it's really being dictated by an almost inevitable force. The core investment thesis here is, well, it's pretty simple. Demographics.
Right.
By 2025, nearly 19% of all Hoosiers, that's well over 1.3 million residents, will be age 65 and older. This is what some are calling the demographic tsunami.
Wow, 19%. So almost 1 in 5 Hoosiers over 65. That's not just a wave. That really sounds like a flood getting ready to hit the rental market.
Precisely. Yeah. And you can already see the demand pressure today. In the Indy metro area specifically, the 65 and older renter population, it's already skyrocketed by 52% in just the last decade.
52%, yeah.
This relentless demand, it keeps utilization extremely high. Nationally, senior living occupancy sits around 88.7% as of Q3 2025. So this acute need, it really suggests a kind of built-in stability for the Indianapolis market.
Which explains why those stable, predictable returns predicted for Indy are just so appealing. Okay, so let's unpack these demographic tailwinds a bit more. Let's figure out exactly who is moving and maybe more critically where they're going.
Well, if we zoom out to the statewide picture first, Indiana's overall population growth, it's actually slowing down, projected at just, 5.6% through 2060.
Okay.
But the senior cohort, that's the great accelerant here. The 65 and over segment is projected to balloon by 20% by 2030.
20% by 2030.
Right. And what really dictates sort of the operational strategy for investors is the growth in the highest need group. The 85-plus population. That's projected to grow by a staggering 50% by 2030.
Wow, 50%. That acceleration in the oldest cohort, the 85-plus, that absolutely dictates where investors need to focus their services, doesn't it?
Exactly.
So focusing back on the Indy metro area, we're looking at over 250,000 seniors by 2030. Now, the sources, they seem to show a really clear pattern. The northeast suburbs, places like Fishers and Carmel, they're absorbing like 40% of the new moves. That kind of concentration, it seems a little risky maybe. Why is the pull so strong there? Is that sustainable?
Well, the initial pull, it's often driven by things like amenities and walkability. These seniors are aging more actively these days. However, the really sustainable investment insight is actually more clinical. Proximity to the major healthcare anchors, think IU Health North or Franciscan Health, that's what really stabilizes operations long term. We actually see that proximity acting as a definite 20% occupancy booster for nearby assets.
A 20% booster just from being near a hospital system.
Yeah, tenants, or maybe more often their families, they prioritize that immediate access to medical services when they're making these really crucial housing decisions.
That makes, incredible financial sense when you put it that way. Now, let's talk market segmentation, though, because not every senior has the cash out potential to target Fishers. We really need to contrast the submarkets using that affordability factor.
Absolutely. So you look at the south side, particularly Greenwood, it sees about 25% higher demand, specifically from folks prioritizing lower costs.
Okay.
The median rents there, they tend to settle around $1,200 a month. That's significantly more achievable than, say, the $2,000 average you might find for a similar independent living unit closer to downtown or up in the Northeast. Right. So you really have two pretty distinct investment approaches emerging based on price point alone.
Okay, so let's transition and unpack the financial metrics then. We've established the demand is, enormous, but what are the actual returns looking like? Current market status shows Indy metro occupancy. It's sitting slightly above the national average, right? Somewhere between 88% and 92%.
That's right. And independent living specifically is climbing past 89% occupancy. The returns profile is generally very strong.
How strong?
Well, stabilized CAC rates, which is basically your initial annual yield potential once an asset is fully operational, they're consistently hitting 7% to 8% in Indy.
7 to 8%, okay.
And that comfortably outperforms the 6.8% national average for senior housing.
Wait, hang on. So if the national average is 6.8%, that difference, that's pretty significant. Why is Indy outperforming its peers like that? Is it just pure scarcity driving up that return profile?
Scarcity is a huge factor, yes. But so is the overall financial stability we're seeing. Year-to-date total returns, they stand strong at 4%. And that's outpacing general multifamily benchmarks, which are sitting around 2.5%.
Okay, 4% versus 2.5%. Nice.
Exactly. Furthermore, the rent growth forecast, specifically for Indy, is robust. It's projecting about 3.5% year-over-year growth. And because these are often pretty specialized operations, once that initial ramp-up period is complete, the net operating income margins, the NOI, they're strong. They stabilize between 35% and 40%.
35 to 40% margins post-ramp-up. Okay, so let's talk about those specific advantages Indy has, the competitive moats, as you call them, that explain this performance differential. The first one seems obvious: affordability for the resident.
Right.
The median 55-plus home price in the metro is $255,000. That's dramatically below the national median, which is, what, $325,000? Seniors moving here can unlock just massive liquidity from their previous homes.
And that cash-out factor, it feeds directly into the second major moat, the supply crunch. Inventory growth is just at a record low right now. It's sitting at a mere plus 0.97%.
Under 1% growth. That's basically stagnation.
It is. It's near stagnation. And this scarcity, it creates intense pressure. It overwhelmingly favors acquiring and rehabilitating existing assets. When inventory is this tight, securing functional properties becomes paramount because, frankly, ground-up construction is just too slow and too costly right now.
Yeah, that makes sense. And while, a lot of people might think of senior living as maybe low-tech, the sources are pointing out that the premium assets are increasingly defined by technology. About 25% of new builds are integrating things like AI fall detection. So what's driving that 15% premium we see forecasted for 2025 in these smart seniors housing units?
It's peace of mind, primarily, for the family. These technologies, they don't just reduce liability for the operator, which is key, but they also provide a massive amenity for the residents themselves and, critically, for their adult children.
The children are often the decision makers.
Often, yes.
Right.
So that 15% premium, that's basically the market compensating operators for integrating these state-of-the-art safety features, features that the newest wave of seniors, who are, often pretty digitally savvy themselves, they now expect.
Right. Expectations are changing.
Definitely. So to take advantage of this unique, high-demand, low-supply environment, you really have to be precise about your investment vehicle. We've kind of broken this down into 3 distinct investment pathways. And it's worth noting, the fastest route to stabilizing returns is generally through existing assets right now.
Okay, path 1. Let's start with maybe the entry-level play, residential units. This sounds like it targets those 55-plus condos and townhomes, perfect for, say, individual investors looking at personal use or maybe light rentals.
Exactly.
We're talking an entry price range here of maybe $200,000 up to $800,000, with the median condo price around $249,900, you said.
That's the range. And the ROI model here, it provides pretty steady growth. So for maybe a $300,000 purchase, you could reasonably estimate about a 6.5% cash-on-cash return in year 1.
6.5% cash on cash year 1.
Right. And over 5 years, that could translate to an 8% internal rate of return, the IRR. That's the total annualized return. As a concrete example, there's a new 55-plus townhome community out in Westfield Osborne Trails. It's already demonstrating about a 6.5% rental yield right out of the gate.
Okay, interesting. So moving up the scale then, we hit the bigger swings. Commercial multifamily, these are the income engines, as we called them.
Right.
This involves existing assisted or independent living complexes, maybe 20 to 200 units, targeting acquisition prices of $1 million to $3 million, maybe more.
Correct.
And the goal here is high net operating income, often using leverage, with rents maybe hitting $2,000 to $3,500 per month.
That's the profile.
Yeah.
And this pathway, this is where you really see those stabilized cap rates hitting the 7% to 9% range. The 5-year model here projects a strong 10% IRR.
10% IRR.
Yeah, and the sources, they actually point to a specific case, a 50-unit assisted complex in Lawrence. It was acquired late 2024, started around 88% occupancy,
Okay.
and achieved a 9.2% IRR by Q3 of 2025. Climbed really quickly. That rapid absorption is just a powerful indicator of the underlying Indy market demand.
That's fast stabilization. Okay. And pathway number 3. For the alpha seekers, the investors really aiming for maximum upside. We have hybrid or redevelopment plays. These sound like niche value-add projects, maybe in the $1.5 million to $5 million range. And the goal is maximizing returns by strategically rehabbing, adding high-value features, like converting unused common areas into specialized therapy suites, things that command higher rents.
Exactly. Things that can command maybe 10% premiums on rents. This is definitely the most complex, but also the most aggressive model. It shows the highest projected return, around an 11.5% IRR over a 5-year hold.
11.5% IRR.
Yeah, with final cap rates hovering around 9%. These projects, they thrive precisely because that limited new inventory forces seniors and their families to choose well-renovated existing space over, waiting years for potential new construction that might never materialize.
Right, capitalizing on the supply crunch. Okay, this is where it gets really interesting for a lot of listeners. How do you actually finance these deals in the current 2025 environment? We need to look beyond just traditional banks, right?
Absolutely. For residential buyers, the options are pretty tailored. So individuals aged 55 and over who are maybe first-time home buyers, they should really look into the IHDA Next Home With Plus program. It offers substantial $7,500 grants.
7,500, okay.
Yeah. And for those 62 and older, reverse mortgages, or HECMs, they offer a structured way to access home equity specifically for purchasing or refinancing a primary residence.
Okay, those are good individual options. But the real game changer for commercial buyers seems to be this HUD 232 or 223F program. Why is this considered such a power play for acquiring or refinancing assisted living facilities?
It really comes down to the stability and the leverage it offers.
Yeah.
HUD 232 is a special government program. It's dedicated solely to healthcare facilities, including senior housing.
Okay, dedicated.
Yeah. And this structure gives you incredibly low fixed interest rates. Think 3.5% to 4% right now, extremely long 40-year terms, and very high leverage, up to 85% LTV, loan to value.
85% LTV, 40-year term.
Right. And crucially, these loans are government guaranteed and often non-recourse. That dramatically lowers the personal risk for the investor.
That makes total sense. The government clearly wants these essential assets to stabilize, so they're offering these incredible terms to encourage investment. What about funding for, say, new builds or major expansions, though?
Well, for construction or major expansion projects, the SBA 504 loan program is also quite powerful. It can allow for very high leverage, too, sometimes up to 90%.
90%.
Yeah. The main takeaway here is that federal resources are pretty intentionally aligning to support both the stability and the necessary growth of senior housing infrastructure.
Okay, and we have a fantastic real-world example from the sources that really highlights how this smart financing combined with good operations can meet that market demand. The $2.8 million Greenwood flip.
Right.
The initial challenge was, what, a 45-unit assisted complex suffering from deferred maintenance, only sitting at about 82% occupancy?
Not great.
No, definitely needed work. So the management team, they acted fast. They immediately utilized that low-rate HUD 232 refinancing option, locked in a rate around 3.75%.
Okay.
And that fixed low cost of capital. It allowed them to redirect their operational cash flow directly into focused, quick renovations, targeting exactly what the local market needed.
So it wasn't just about getting cheap money. It was about smart operational management using that financing advantage to turn a deferred maintenance headache into potentially massive returns.
Exactly right. And the outcome, it really speaks for itself. Occupancy hit a robust 94% in just 14 months.
14 months to get to 94%. Yeah. Netting a 12% internal rate of return for the investors. That rapid stabilization just proves the strength of that underlying demographic demand when you combine it with savvy execution. And speaking of execution, the buying process itself really matters here. The sources emphasize that using a kind of battle-tested blueprint, focusing on intensive due diligence, maybe some off-market sourcing, that can actually shave 10% to 15% off the standard 45 to 90-day transaction timeline.
So speed is equity in this environment.
Absolutely. Getting deals done faster locks in value sooner.
Okay, so let's try to summarize the key takeaway here for you, the listener. 2025 looks like a critical inflection point for Indianapolis senior living. This whole environment is driven by this really unique confluence of factors. Very high senior population growth, projected at 31% by 2050.
Huge growth.
Critically low inventory growth, currently stuck at just 0.97%.
Almost nothing new being built.
And very favorable stabilized cap rates compared to national averages, sitting between 7% and 8%.
Right. Now, we absolutely must discuss the two primary risks that were mentioned. These demand critical thinking from any potential investor jumping in. The first is regulatory shifts.
Okay.
Often resulting in what the industry kind of calls acuity hikes. This basically means the state might suddenly require a higher level of care or maybe increase staffing ratios for certain resident types
Which hits your operational budget immediately.
immediately and directly strains your profit margins. It's a big one to watch.
Okay, and the second major risk is that pervasive labor problem we hear about everywhere.
Correct. The persistent challenge of labor shortages. It's resulting in a pretty high 15% vacancy rate among caregivers in the sector right now.
15% vacancy.
Yeah, and that means that even if you have high occupancy, it doesn't always translate directly into high operational profitability if you simply can't fully staff the facility to meet resident needs and regulatory requirements. These risks demand really strong operational planning from day one.
Those risks are definitely real. But the momentum and the potential financial upside seem clearly enormous, mainly due to those supply constraints. Which leads us perfectly into our final provocative thought for you to consider. If existing assets are so overwhelmingly preferred right now because the pace of new inventory is just record low, how much could the forecasted cap rate compression, that's cap rates going down, prices going up of maybe 50 to 100 basis points before 2027, how much could that accelerate the rush to acquire these existing functional properties right now that potentially shrinking time horizon could really dictate the success of your next move?